Today we'll talk about liquidity, especially for on-chain protocols, how that's important to bootstrap protocols and how there's inefficiencies, and how Lucidly Finance is trying to address this. And for that, we got ETH Sign with me here today.
Let's call this problem liquidity renting. So when you launch a new offering, you require some amount of initial liquidity to sort of get things going off the ground. So basically you need a place where protocols can come in and say, hey, this is the amount of money I'm trying to raise and this is the amount of incentives that I'm giving. The volume of money being channeled through these markets is not really that big. But the thing is, if I'm able to structure it into a more accessible financial instrument, then it becomes easier to use.
All right, real quick. We recently partnered with the Stellar Development Foundation on an exciting campaign that they're running called BetterOnStellar. They want to hear your ideas for how to make the world better with blockchain. No need to be an engineer, just think of a problem that's important to you and tell Stellar how you'd like to see someone build a solution to it on their network. The best ideas will win a share of $30,000 in USDC and exclusive merch. Plus, they'll also be used as prompts for future hackathons where real builders will bring your ideas to life. To enter, just post your idea on social media, #BetterOnStellar, and you can share it as a video or just write it out, but only videos will be eligible for the top tiers of prizes. Once you've posted it, make sure to submit your entry on the official campaign website as well. So head over to the link below and share your idea for a chance to win. All right, everyone, thank you for tuning into another Teach Me DeFi episode. Today we'll talk about liquidity a lot, especially for on-chain protocols, how that's important to bootstrap protocols and how there's inefficiencies, and how Lucidly Finance is trying to address this. And for that, we got ETH Sign with me here today from Lucidly Finance. If you want to give us a quick intro, and perhaps also put it a bit into context, that would be interesting, because most people are probably not aware of, I wasn't aware of the issues around, or the topic in general, how on-chain protocols have to make like deals to like bootstrap liquidity so their product becomes useful in the initial stage, and how that's quite inefficient. But yeah, you can
Exactly.
you go off. Yeah.
Yeah. So let's call this problem liquidity renting, on-chain liquidity renting, right? Like it's not a problem. It's sort of just how it is. It's a phenomena. You can call it. It's just a thing in DeFi, in finance, basically. So when you launch a new offering, when you have any kind of new DeFi primitive launching, you require some amount of initial liquidity to sort of get things going off the ground, right? Normally, what happens is, as a protocol, I go to market makers, professional, like there are professional firms in the space who do liquidity provisioning in DeFi as a business. There are I could go to like whales, people, just basically people who deploy liquidity, right?
How do you know these people? Like, how do you told me a bit, because it's like a bit intransparent how you actually do these deals, right? And like, how does this currently work, this whole thing?
It's not really that hard to find people. It's basically, so people are always happy to sort of buy tokens, newer
Yeah.
projects, right? So when you have a decent enough product and there's some scope of future growth, revenue, whatever, people are happy to sort of at least take a look. Yeah, like it's like like these are like regular people you can find on Twitter, the same sort of famous people on crypto Twitter, or even if you go talk to any, let's say, market making firm or anything, they can happily connect you to people in their network who do
Ah,
liquidity
okay.
provisioning as a living, basically, right?
Hmm.
So like this is a business. This is an entire industry. What they do is basically they provide loans to DeFi protocols or just crypto businesses for liquidity provisioning purposes. That's basically their business model, right? And these could be individuals as well, right? Like I could be a rich guy, I could be a whale with like say $100 million. Hey, I'll just punt $10 million into your Silicon protocol and give me some incentives, right?
Hmm.
So now you have some numbers, you can quantify it. The cost of capital, which is basically the cost of not selling that token, whatever the value of that token is worth. So basically, they're asking me to hold a certain amount of value, right? And the cost of capital of that is the amount of tokens that they're throwing at me, the amount of incentive that they're giving me.
Yeah. Can I follow up on this? Because it sounds to me like, something that was on chain first, which was those crazy yields that you would get when you provided liquidity in those
Exactly.
protocols. That was the way it used to be, and now this sort of has moved into deals which are made in the darkness, so to say, in the dark,
It's
with market makers and so privately, who then get a higher yield for providing the liquidity than what the protocol pays on chain if some normal user is providing liquidity.
Yeah, there's a reason that the market has become what it has become, right? There was very good reason for the market to move in this direction, wherein these deals go private, right? People, there was good incentive in, like in the market, to bring that market off chain, right?
Mm-hmm.
Because like with those crazy yields and hacks going on and a lot of things, there was a lot of value lost, to be honest. People lost money. Protocols bled their treasury out. um, right, a lot of protocols died. They didn't have enough to operate. They continue operations and everything. uh, but yeah, like everyone remembers DeFi summer. um, right, but now, like to make things more conservative, to sort of what happens now makes more sense than what used to happen, which is a natural uh, progress. Like you can call that progress, right?
Mm-hmm.
um, and private banking happens this way, like white glove private banking. This I had a conversation about this, like a really smart person about this. And this liquidity renting deals off chain thing happening is very similar to white glove private banking. Like one can argue that there is good incentive for either parties to not disclose the deals numbers that they are doing, right? Like as a protocol, hey, I'm renting liquidity and I'm diluting supply. Do I want other people to know about it, right? Um, or as a liquidity provider, I have this opportunity, right? I have this high yielding opportunity uh, on my table. I'm taking it. Do I want other people to know about it? Obviously I do not. I'm getting some tokens at a certain valuation, and it's a project that's not live yet, or maybe like that's like in majority of the cases these tokens are not live. So I'm basically getting allocation for putting up initial, so for basically signing up as an initial depositors. I don't want other people to know about it, right?
Mm-hmm.
But there are a lot of value leaks in the process, right? This thing can be streamlined for multiple people. There's uh like it's too, like what the problem is that it's too close right now, right? And my thesis, like our thesis as a team, is that there's, like, if you make this more streamlined, if you make this more accessible, the markets will end up being more efficient.
Right, because for me, this it did sound not intuitively optimal, right? That you're pulling this into private deals now instead of having it on chain. But you guys are trying to create a market now for these sort of initial liquidity provision deals, right?
Exactly. Like it's not just initial. It's for it's for basically it's for management. You can use it all the time. Like you need liquidity all the time, right? Like the cost of providing liquidity is always, like a liquidity position always has a premium to the risk profile of an liquidity position, always has a uh, sort of premium to the native asset. Providing liquidity to a certain asset will always going to be more uh, capitally expensive than just holding the asset, right? Um, it's just how finance works, right? But the thing is that, like, we're not just like, our thesis is not that we are trying to make this open just because it should be open. Like, like, there are some things that should, like, people don't want to be public, right? There are certain things that people, um, like like I said, the point still stands. As a liquidity provider into these deals, you take significant risk, right? when I sign up for being a depositor into a new protocol that has not been proven to have like PMF in the market or is relatively newer, I am taking significant risk by locking up my capital, right, into that protocol. And so the incentives I receive for this opportunity, it's well earned, to be honest, right? Like
Mm.
I have done my due diligence, I have done multiple things, and if I get incentives, and if now this deal becomes open, there is like I stand to lose, right? Compared comparatively, uh, this thing still stands, right? But the thing is, there is room for improvement in this market, which there is yet to be a 0 to 1 unlock in this thing happening. We are sort of trying to build into a market where like the numbers for these deals are like really not that big compared to other like TradFi markets, basically, right? Um, if I compare these sort of if you compare numbers to what is happening in DeFi right now, like DeFi TVL is about like $100 billion on an average right now, right? And you've seen like the newer, at least on Ethereum, the relatively newer protocols. There's Ethereum, there's Eigenlayer, Aave is like growing really big. Um, like so the amount of money that's being like the volume of money being channeled through these markets is not really that big right now, right? uh, but the thing is, if you structure it, like if I'm able to structure it into a more accessible financial instrument, people will use it because then it becomes easier to use. um, just making a thing way more easier for people to use like is a 0 to 1 unlock in like in my opinion. Like you can like it's the same experience as a peer-to-peer, let's say, like fiat on-ramp off-ramp. Let's compare the experience of a fiat on-ramp off-ramp experience and a simple trading like swap experience, right? So what we have in sort of liquidity renting markets right now feels like a Telegram OTC transaction, right? You talk and you fill a Google form, um, you hop on 5 calls, you talk to so and so people, and there's a time when hey, deposits are live. You see in you see in a group chat, people are talking and everything happening. And what we are offering sort of as a product is it's a product. You go to a website, there's a secure protocol on chain where you can list markets. As protocols, you can create markets. As LPs, you can see opportunity, like you can see basically the markets that have been listed. You can see what protocol is trying to raise how much amount of money, and um, basically have take your own decision and put in deposits. Right? Like from a user point of view, it's basically the same as farming any other DeFi protocol. You won't even know, right? But the 0 to 1 unlock is now your entire on-chain experience is fully transparent. It's being structured. It's being like every dollar that you put in is being quantified for. Like every like whatever amount of money you're giving to a certain protocol, you're being compensated for it, right? You would know if you're being compensated for it because now there's a framework for that. That's what we're trying to do at Lucidly. Protocols need to provide incentives. Like you have to. So take the example of Curve. Curve's launched a stablecoin, and now they have saving CRVUSD, like another token, right? And what is the point of saving CRVUSD? It's supposed to be a supply sink for CRVUSD, right? So if you go to CRV, if you go to this vault called Saving CRVUSD, it's basically a platform. It's basically a smart contract where you just deposit your CRVUSD and it redirects a certain amount of revenue from CRVUSD to this vault. The amount of money you put into that savings CRVUSD vault does nothing. It just sits there, right? and they channel some revenue off the CRV USD, like the money being paid to Curve by CRV USD minters, like people who mint CRV USD and pay interest. Some amount of that money goes into this vault, right? So what actually is happening is that you're being paid by Curve to just hold CRV USD, right? The same thing happens to, let's say, people who stake Aave in the safety module, or people who, um, for example, like Stader gives out incentives, Lido gives out incentives. Um, it's basically the rate. Like what I'm talking about is the budget that you allocate to incentives, right? That has a number to it, and there's no framework in the market to help you calculate that number. Let's say
Yeah.
you have your stable coin, let's say, and you're listing it on Binance. Is it You're listing on Binance, right? You have to pay a market maker, right? Why do I have to pay a market maker? So that the stable coin on Binance has a market depth 24/7, so that there's an active buyer or seller for that token on Binance, right? And the market maker incurs a cost of liquidity provisioning, right? They do their own liquidity management things, and they incur a cost. Who's going to pay for it? I pay for it as a protocol. That's the premium that I pay to the market maker for, sort of taking that extra risk, and they quote me something, right? So, and they have their own risk teams and everything that help them get this number. Hey, this is your risk profile, and this is how much you should pay me. This is the extra amount that you should compensate me with, right? So that's how you do things. This thing does not happen on chain. Like if you, like, a very good example is, I can lend money on, like, think very bare bones. I can lend money or to a vault on Morpho, or I can supply money on Aave, right? What should be, like, what is the cost of capital in either places? Like, if I'm putting money in Aave, and if I'm putting money on Morpho, if they're different, why are they different? What is the risk profile in either cases? What incentive do I have to not switch from Aave and go to Morpho, or the opposite? Like, let's say I start a protocol and I'm giving out, let's say, 10% APR, and I have a bunch of users, or maybe I don't have any users at all, right? In case I don't have users, I'll start increasing my incentive rate, right? But how up do I go? What is, like, it's, like, how higher should I make my incentives? Or if I have a bunch of users and I'm bleeding so much money in incentives, I want to reduce that. How much should I reduce, right?
Okay, so let me sum this up. So I think we need a bit more of like an on-point summary,
Okay,
and
okay,
maybe in my own words,
okay.
maybe I don't know, maybe this helps viewers as well. So right now, a protocol would be paying out yield to anonymous LPs on chain, but they don't really know, is that the cost of capital that they have to get this liquidity or not? Like, are they paying too much? Are they paying too
Exactly,
little?
exactly,
So they're just blindly paying out those yields. So
exactly.
now you're creating a separate market for sort of finding that cost of capital, because you create basically an order book where liquidity providers say how much they're willing to provide for what yield.
Mm-hmm.
And now you can find the optimum there and be like, okay, this is the yield I have to pay out based on all these different offers I'm getting. So then you know your cost of capital now to sustain your DeFi product or whatever,
Exactly, exactly.
on-chain protocol.
Mm-hmm.
And now you can also accordingly adjust the yield that the protocol itself is paying out. Is
Exactly,
that
exactly.
about right?
Yeah. Like what you just explained is the bare bones, right? What you just
Mm-hmm.
explained is the bare bones.
Mm-hmm.
Now imagine automating risk management. Now imagine giving data to everyone so that they don't have to figure out what quotations to put on the order book,
Mm.
right? Now, like, imagine the user does not have to think about how much incentives they should ask for providing liquidity. They have a number on the screen that's been figured out by a certain risk management team or on a bonding curve,
Mm.
right? Let's say the ask for liquidity is auctioned off,
Mm.
right?
Mm.
Yeah,
Okay.
this experience.
These are different price, like these are different price finding mechanisms then, basically.
Exactly.
Okay.
Exactly.
Mm-hmm.
Now imagine this entire thing automated.
Mm-hmm.
Like basically, like end of day, it's basically a mechanism to find the cost of capital on a certain venue. That's it. Like,
Yeah, that's a good on point, like very on the point summary. It's a
yeah,
mechanism to find the cost of capital for an on-chain protocol. All
exactly.
right. Do you want to just share the
Yeah.
screen?
So this is a vault product that we have launched. This basically a very user friendly and also like sort of known product type for DeFi people. It's supposed to be a simple yield bearing vault product from a user point of view. So we have partnering up with some certain protocols. You can see a Puffer vault, you can see an Athena vault, and there's an SXE vault from Stakeys, and we have some other protocols coming up. These are basically simple, like from a user point of view, these are just yield aggregator vaults. You can put in money here, and we're going to do something with that money, right? And we're going to give you yield. That's it, right? What happens behind the scenes is that we use this capital to provide liquidity for every major DeFi venue for these protocols. So the money you put into the Puffeed vault is used to make sure that Puffeed is liquid across venues. That Puffeed is liquid on Morpho. Uh, like the Puffeed market on Morpho is always healthy. It makes sure that Puffeed curve markets are always balanced. It goes to make sure that Puffeed is always very close to peg, right? It basically makes Puffy as a product, as an asset, liquid. The same value proposition for Athena and SXETH, basically. This is what happens, right? So we are launching these markets. This is the Puffy Vault, and we have been running this one product, like this one vault. We've been running it internally for about 2 months. It's giving good yield, decent yield. We're using our own money. What's happening behind the scenes is that, like I said, money into this vault is used to make sure that there's like basically use lesser amount of capital to you than in the available market to make the underlying asset more liquid. Uh, what happens, like how this happens is that the money you provide, like money you deposit into this protocol, what it does is it sort of rebalances liquidity in and out of these protocols. Um, with like it basically acts as a sort of on-chain market maker for these protocols. In very simple terms, we're plugging this into our incentive negotiation market after this, right? So now what was going to happen is that these protocols are going to be offering different incentive rates for providing liquidity into their so many different liquidity venues, right? And all of that incentive is going to be plugged into this one very simple yield bearing vault. So, from an end user point of view, what you have is a really great, transparent, structured product that just lets you put in money, and we are yet to like sort of put in more data points into the vault, like into this web app. What we are trying to design this is basically like a Bloomberg for yield. Like yeah, if you yeah, if you can think like that. um, so what's going to happen is that we are going to start growing these vaults and then have these protocols sort of put in numbers, like incentive numbers, using our auction protocol, and that's going to give you accurate numbers that hey, you are an LP to the buffer, let's say some buffer ecosystem, right? And this much of your money is used to make liquidity on curve. This much amount of your money is used to provide margin on Morpho, right? And this is the risk profile for either of these venues, and this is the extra incentive that you're getting on each of these venues, right? And this is the average market rate for providing liquidity on Morpho. And this is the average market rate for providing liquidity on Curve. And you are X bips above that or you are X bips below that, right? So you get numbers like this, right? Um, we handle the risk management in house, and the end product is basically like a super structured, quantifiable, transparent um, yield product, basically.
So what is the current status of like go to market for this?
Like I said, like our go to market, we're trying to sort of make it very easy for people to sort of uh, come and use the product. First of all, we don't want to make it too complex for the user to come and understand, like try to learn what to do. We're trying to,
Hmm.
so, and that is exactly where we have sort of packaged our entire sort of capital efficiency stuff that we have done into this vault product, right? So from a vault perspective, like it's a vault, it's a very boring product. Come and use it.
Hmm.
We're gonna make it more interesting. We're working with a bunch of like very sort of like really good protocols out there that are building sort of really cool um, sort of yield mechanisms. They have different products, and we're trying to sort of work with them, create incentive markets with them, and we're going to structure those sort of like structure like their sort of strategies into this one world product and offer it to our users. So from a user point of view, you see different new protocols coming up, um, and the best way to provide liquidity to them would be through Lucidly. um, that's how we're trying to structure ourselves. We have some vaults listed on our website right now. It's app.lucidly.finance. In the coming weeks, we'll have um, like a lot more improvements in terms of the number of vaults that we have listed, the amount of incentives that you'll be getting as an user. um, and yeah, I think that's it.
Okay, that's pretty cool. Is there any timelines or anything like that that you already can share?
Yeah, so about like a couple of weeks from now, we'll have our auction markets set up on our website. We'll have a couple markets live with incentives by then, and we'll have like three more vaults with some like with really big protocols um, listed on our vaults page.
Okay. Do you expect, based on the mechanisms you just sort of like described and the incentives, do you expect there to be an influx of liquidity into this?
We do. We are in talks. We are talking to a few sort of initial partner projects that are sort of like on the business side. We're trying to like we have some partner projects that we are working with, and sort of bringing liquidity to these markets is the sort of key metric here. Like I said, the point is not sort of getting a shit ton of liquidity and then call it a success. Our core proposition is basically first quantifying your cost of capital and then
Hmm.
find ways to sort of improve it, right? Uh, uh, like once you know how much is the cost of your capital, you can find ways to make it cheaper, right?
Yeah,
So
but
that,
to be able to find your cost of capital, the volume sort of matters too. Or like
yeah,
if just a few guys are saying, okay, I'll provide like 10K or something at this price, it doesn't necessarily mean that the
yeah, like
protocol
yeah.
can get like a lot of liquidity at that price,
Exactly.
right?
Right. Yeah. Like there's obviously some numbers are needed. We need a lot of participants when these auctions happen. We need very robust sort of risk, like sort of risk frameworks while creating these auctions, basically, right? So we're doing that. But yeah, we definitely expect a, a good amount of interest when we sort of make our first auction markets live. Then that's obviously the goal. There are efforts being made to sort of getting a lot of new protocols come up and try our auction markets sort of to raise initial liquidity. There are a lot of newer ecosystems coming up, a lot of new L2s launching, where we are sort of working and trying to sort of get in touch with more of them.
Hmm.
So yeah, that's the growth plan. The
Okay.
grow the like once we have the tech solidified, it's like go sort of scale, please.
Yeah.
Let's scale. Sorry.
Okay.
Yeah, that's the
Sweet.
plan.
Yeah, awesome. It's not a simple topic to wrap your head around, but once you kind of understand it, it's super interesting. I hope this can serve sort of as a resource to kind of like understand this topic. I haven't seen any other podcast talk about it. It's an interesting issue, I'd
Hmm.
say, in terms of
Hmm.
on-chain protocols and liquidity. And yeah, it's an interesting solution that you're building. I'm curious to see how it evolves. Let me know when they're built. I'm definitely interested in keeping up to date with you guys. Yeah, I mean, awesome, man. Thank you for coming on the show.
Thank you.